Okay, so we've done the deferred. Now it's time to hit the accruals. Okay, first one that we want to attack is, of course, accrual revenues. And these are again revenues earned in a period that are both unrecorded and not yet received in cash or other types of assets. And these adjusted entries will recognize, of course, an increase in revenue because we've earned it, and usually increase in a specific asset, normally a receivable, pretty much accounts receivable. Again, there's our nice little picture. So they have it October 31st, revenue and receivable are recorded. November 10th is when we get paid. Yay! So here's our example for Sierra Corporation. Program guide services worth $200 and were not billed to clients on or before October 31st. So again, at the end of the period, we have incurred revenue. We just haven't recorded it yet. So, does the customer still owe us money? Yes. Have we earned that money in the current period? Yes. So, we have to record it. Again, showing what happened in that month or in that accounting period. So first off, step one, what's the current balance in relation to this transaction? Should be 0 because we didn't make anything for this yet. Step two, what should it be? Well, it should be 200. We should have accounts receivable balance of 200. That's how many people owe us money. Not a lot, but it works. So step three, what accounts are affected? Well, we must increase accounts receivable to show that we have $200 that is owed by customers that we expect to receive at a later time. Well, why do we write this account? Well, because we've earned money. So we performed our job, we've earned it, it just hasn't been billed yet. So again, with our equation analysis, we add 200 to accounts receivable, and we show an addition of 200 overall to stockholders' equity and service revenue. And then here's our table. So adjustment number 5, 200 right there, 200 over here, and it's all about service revenue. Whoops, go away. Alright. Now we have our note here. And this note is what happens when we actually receive the cash. So again, November 10th, we do get paid. Well, since we've already recognized the service performed and revenue, all that really happens on November 10th is that we recognize the increase in cash and basically the payoff of the receivable. We are no longer expected to receive cash from these customers. And that's what we always do at the next period when cash is finally in for an adjustment to accounts receivable or accrued revenue. So now we can hit accrued expenses. And these itself costs incurred in an accounting period that are both unpaid and unrecorded. So again, we've accrued or incur an expense, and we have yet to pay it, and we haven't recorded. That's all it really means. So for this adjustment to show what happened, we're going to increase our expense to show that the expense did happen, and we're going to record it as a liability due to us not paying it yet. So this will pretty much be hit with a payable in some aspect. Because again, we still owe the money, we just haven't paid it. So the first one we're going to hit is a finance one, and this is accrued interest. Okay, and again, this is mostly when a bank allows you to basically pay interest either at the end of a note or sometime later, and not exactly in the period you're working on. It could be the end of the year, so it could be December 31st, and we're recording it based on a month. Could be. So, starting off first, the biggest thing that you're going to have to remember is the simple interest formula. Once you get into your finance class, if you ever take one, you'll get to dive deeper into interest. But here, we're just going to do the simple. So, the simple interest formula right here is principal. So we take the principal, we times it by the annual interest rate, and then times it by the fraction of the year. So, if we're only using 1 month, well, usually that's 1 divided by 12. If we're using 3 months, 3 divided by 12. If we wanted to turn it into days, we could, and use 365 days. We'll be close enough. So, with this, Sierra Corporation signs a 3-month note payable in the amount of $5,000. The note requires Sierra to pay interest at an annual rate of 12%. Now we already know it's going to end before the annual rate actually happens because it's 3 months. But that's still an annual rate. It's 12 months right there. But we're going to calculate the interest at the end of October 31st. So, step 1, current balance. Well, we haven't recorded anything yet for interest. So, it's at 0, our interest expense. Next, what should it be? Well, we have to use the formula to figure this out. So, we take 5,000 times 12% times our fraction of the year, since again it's 1 month, 1 divided by 12. So we come out to about $50 of interest expense. Not bad. Not bad. We know if this was a credit card, that would be a lot more. And then step 3, what accounts are affected? Well, we know we've incurred an expense, so we record interest expense of $50. But do we still owe the money? Yes, we haven't paid it. So that again means we're going to have interest payable to show that we're going to pay this interest, but at a later date. Because if you don't, the bank is going to come after you. And you don't want the bank to come after you, because then they won't loan you any more money when you really need it. So here's our equation analysis. Our liabilities are increasing. At the same time, our equity is showing a decrease of the expense. Again, no asset is affected. So here again, here's our table. Here's interest payable now being added. So $50 right there. So now we have a note payable, account payable, and an interest payable to go along with that note. And then here's our expense of $50. So not bad at all. Remember to put interest expense for the income statement. Now, the major one that gets affected a lot, is of course payroll. Again, payroll tends to get affected a little bit more because the last day of the period probably doesn't always fall on a Friday. Okay? We wish it did, but probably won't. So, here, Sierra pays a total salary of $2,000 for a 5-day work week, paying a total of $4,000 every 2 weeks, or basically $400 per day. It's not bad. October 31st falls on Wednesday during the normal pay period. Uh-oh. So, our ending period that we're going to do our adjustments doesn't fall on the Friday. Doesn't fall on the 5-day work week. So, we have to show that our workers did work and incurred that expense for the business in October. At the same time, we're going to owe the money because, we didn't pay them until Friday or until the 2 weeks are up, which 2 weeks could be the week after, not exactly on Friday. But for us, again, for this pay period, this 5-day work week, have we done anything yet? Nope. Still zero. Haven't recorded anything. So now we get to figure it out. Well, let's see. Pretty much we have Wednesday, which is the 3rd day on the 5-day work week, which means we've incurred 3 days worth of payroll. Well, taking $400 per day, divide by 3, or times by 3, not divide, equals $1,200. Again, to find your per day basis, if it doesn't give it to you, since this is a 5-day work week, take 5, divide it into 2,000. That's where we got the 400. And of course, every 2 weeks, they pay $4,000. Okay? So really, all we do is take the per day, times it by how many days we used in the pay period, or the payroll period, and we multiply. So for us, we know again, our expense is going to increase. So it's a pay period. During the pay period, $1,200 has incurred in October that has yet to be paid. So since we have yet to pay it, do we still owe someone? Yes, we owe our workers. If we don't pay our workers, we're not going to keep them. So this is a reminder that yes, you still have to pay them. So at the end of October, we have a small payable of this pay period. So just like with interest, we're going to increase salary wages payable and decrease stockholders' equity. So by the expense. And here it is right here. A7. So plus 1,200 here for the payable and subtract 1,200 here to show the actual expense happening. So again, here's our income statement, salary and wages expense. Now, what happens when they actually pay the salaries of their workers? So for Sierra, their pay period ends up being November 9th is the payday. Well, they pay the $4,000 for the 2 weeks. So cash does go down. But notice how it's split. Out of this salary or cash we pay, first off, we pay off our debts. Pay for the month of October, those 3 days. And then the rest ends up being an expense, salary and wages expense, to basically show what's been paid in November. So again, 9 days, 9 times 400 will get you to 2,800. Okay? And that's really it there. So we're going to again finish off with a small concept check. Just 3 items here. Again, since this really does not affect, we're not changing any balances. We don't have the balance. We just want to know what the overall change is and what income statement account does it affect, even though these things look a little bit off. There we go. Okay, so go ahead and do this. I'll come back in one more video for over off this concept check, then we'll finish up the notes.